Hello, everyone. Welcome to Wall Street from Main Street podcast. My name is Mo Dawood, alongside Jason Burak and John Manfreda. And today's podcast, we're going to do a 2013 review, and then after that, we're going to look at 2014 and give you guys our outlook. So, guys, how you doing? Happy New Year.
Happy New Year, Mo. And Jason.
Yeah, happy New Year to you guys. Happy holidays, whether you celebrated Christmas, Hanukkah, Kwanzaa, or any other holiday. And Happy New Year to all our listening audience. If you guys notice, we haven't put out a podcast for a while. Been kind of taking it easy for the holidays and relaxing like a lot of other, business people. And, just getting ready for 2014. And I think as resource investors and other small cap investors for other small companies, I think 2014 will be a very interesting year. But before we talk about 2014, guys, Mo, you brought up 2013. So let's talk about, some of the big headline themes that happened in 2013.
All right, so one of the big headlines that happened just recently in 2013 was the Federal Reserve taper of the QE program. It's not much, only $10 billion per month, which if you think about it, it's really very minor. If you look at the balance sheet, because the balance sheet is about $4 trillion and going up.
By about $1 trillion a year, right? It's still going up by about $1 trillion a year, right? And that's just on the face. That's all we know about, officially.
Yep.
Right?
Yep, and we're already starting to see the yield on the bond go up, so I don't think the Feds are going to let this happen for too long in 2014, but we can talk about that later. But I think one of the biggest surprises in 2013 is that the Federal Reserve actually tapered. I think we all agree that we don't think the Fed would taper, mainly because they don't want to see a spike in the yield, and secondly, people are not buying the Treasury bond like they have been before, and the Federal Reserve had been buying them all. So they're the number one buyers, and no one else is really going to buy those bonds. If you look at China and other countries, they're interested in diversifying their currency reserve into a basket of currency instead of just the dollar.
Well, Mo, I did say, and you guys know this, and I said this in all my interviews, I did say there was a chance that they would do a token taper. So I said the odds weren't good that they would do a taper, but I also said, they may do a little token taper just to see what the market's reaction was, but that I don't think the market was going to really like it too much, especially if they tried, a couple token tapers. And I think that's the market's kind of figuring this out, that if they do another taper, they're going to move the rates higher, exactly like you said, and then the Fed's going to have to reverse course. So I think the Fed's in a situation where it can't really take the liquidity out of the system. The QE program, the stated amount now is, $75 billion a month after they've taken the $10 billion out. But it's actually, in reality, it's way more than that because they're reinvesting all the profits from all their other interest payments on all the bonds they hold in their portfolio. And there's a lot of other gimmicks. If you listen to Rob Kirby, he'll talk about this through the over-the-counter derivatives and other exchange rate swap mechanisms where they can put more QE into the different markets. So, talking about the taper, there's a lot of information about that. So let's talk about other things in 2013, unless, John, you have something else to add about the taper.
Well, I was just going to say how much they really tapered, we don't know. Because we know they're taking the investment or the reinvestment and the interest in buying more. So they might have had gotten so much reinvestment that the taper could be smaller than what they told us. So,
well, we also know. We also know, and our listeners can go listen to interviews from Fabian Calvo. He has a really good YouTube channel, Fabian for Liberty. He's a big money libertarian real estate investor. He does, I believe, over $100 million worth of deals per year at the U.S. Note House. That gets him some inside access into the Federal Reserve meetings and other hedge fund conferences and stuff. And from what he was saying, QE was more than 115 billion per month. The Fed governors, other Fed governors, were giving, Wall Street insiders, hedge fund managers, the billionaires, they were given, privy knowledge that the Fed was bragging about the wealth effect, that, we're putting way more than the amount of QE that we say publicly into the stock and bond market and real estate market to make sure they go higher. So, the taper is just, I guess it's just to appease the Keynesians and people like that on Wall Street and the masses to make it look like the Fed's still in control, and also, maybe to make Bernanke look like a scapegoat. So then when Yellen, who is a hardcore Keynesian, right, guys, she wants to raise QE again, either in 2014 or 2015, right, then she can say, well, it was Bernanke's idea to even try the taper, right? And it's not my fault that the stock market dropped 10 or 15% and then, just hit the accelerator again.
Yep, and I agree there with you. So, shifting gears here and talking about the stock market and what it did in 2013. If people remember when we did our 2013 outlook a year ago, we predicted that the stock market would continue to go higher due to the cheap money that the Federal Reserve had been printing, and it looked like we've been correct. The S&P 500 and the Dow Jones went up 25% in 2013. We had a small correction here and there when the Federal Reserve started to talk about taper, but overall it's been a good year in the stock market in nominal terms.
Exactly, Mo. And if I could add some extra points here to your color, you brought up the large cap indices, but you have the small caps, the Russell 2000, I think that was up 35%, although those guys in a lot of aspects have legitimate revenue and profit growth, whereas the large caps did not. But then looking all over the world, you also had other developed country stock markets. You had the German DAX, where the underlying German economy was not doing well at all because Europe is sputtering and China has slowed down, but the DAX, which is the German equivalent of the Dow, I guess, the German stock market, the DAX index was up a lot. I believe it was up over 20% and soaring. And the Nikkei, which is the Japanese stock market, that was up, I think, the highest of any individual stock market. I think the Nikkei was up, 60% or something in 1 year?
Yep.
But that was mostly on...
Priced in the yen, that's why.
Yeah. No one's counting the devaluation of the yen that happened with their QE program, which is actually Japan's QE program is actually even larger than the U.S. and their economy smaller.
Yep.
So
double.
Yeah. So we have just more humongous intervention by the developed world central planners in Japan, in the U.S., in Europe. The U.S. is bailing out Europe. So there's a lot of leakage of QE and other backdoor bailouts and other money that's just going into Europe. And, we did, besides, our 2013 predictions, Mo, talking about the stock market going higher, I think we also did an at-length podcast about how the stock market will not crash. But I think in 2014, to tie this in here, since we'll talk about the stock market still, we may see a little correction in 2014 because there is some sign. There's a lot of insiders in companies who are selling their shares. The amount of insider buying to insider selling is humongously in favor of insider selling at this point. And you also have a lot of other smarter money people who made a lot of money in stocks the last couple of years starting to take profits. But there's, you have the dumb money, the retail crowd who's starting to go into from bonds into stocks now. They're moving your mutual fund money, chasing higher stock prices, especially the large caps. And, it's really interesting here. You just see the retail audience tends to pick out patterns towards the end of patterns. And, I think we're probably due for a small correction in the stock market. I don't know how large the central planners are going to allow it before they increase QE again.
Yeah, and I agree there. I don't think they want a big crash in the stock market. They'll probably step in and probably increase the QE program to more than $85 billion if something dramatic happens and the yields get too high for them, because that's the last thing they want to do. So going back and talking about the stock market and a possibility of a correction, we could see a correction in the first quarter of this year. I'm looking at the chart right now. We're starting to see a small correction, and I wouldn't be surprised if the Dow Jones goes to 1,500 and around 1,500 or 15,600. Excuse me.
Yeah, I agree with your assessment.
Yeah, and then bounce back up there from there. So yeah, I agree with you. We should see a correction in the first quarter due to the taper.
Yeah, I think the taper talk will interest rates will start to rise. I don't think they'll stay there because I think they'll say tapering's off the table or it's off the table for the foreseeable future. But I think it'll be due for a correction just because the perception is as the government fudge the numbers, Wall Street trades around them, so they'll price in a recovery, higher interest rates, and people will leave equities and take profit because of uncertainty. So that's why I think there'll be also a correction too.
Exactly, John. And let's talk about the real numbers, because I think you touched on that. Is the real numbers, the real unemployment, real GDP, real earnings from these companies are garbage. The truth is garbage, but Wall Street doesn't care. They only care, these trend trading hedge funds and large money managers who are managing billions of dollars only care about what happens, today, tomorrow, next week, next month, next quarter at most. If you actually talk to them and they give you even a minute of your time on Twitter, or you reach out to some hedge fund managers on Seeking Alpha or wherever, they don't care, most of them, what happens a year or two from now. They don't care if the United States is in a crisis, most of them. They just don't care as long as they meet their trading goals and they beat the money manager next to them, and they get their bonuses in the short term. So this rent seeking is just bad. To add a point here about the fundamentals of individual companies, David Einhorn, for our listeners out there, is one of my favorite value investors. Like Kyle Bass, there's other investors I pay a lot of attention to. But go read David Einhorn's October 2013 newsletter. You can find it for free. You can just Google it, and you should be able to get the PDF for free. Anyways, he talks about their in-depth, about all the games that the companies are playing with earnings, and how analysts are lowering the revenue and earnings expectations so much. So, for example, you have a situation where early in 2013, guys, you had companies like Alcoa and other large-cap stocks, and I don't just want to pick on Alcoa because almost every large-cap company is doing this, but the revenue and earnings estimates were 40, 50, 60% higher, right, for the year, for each quarter, and then 2 days or a week before the company's about to announce earnings, they contact all their analysts and tell them, well, these are what our earnings are going to be, and the analysts or guidance, these are what our estimates are going to be, and then the analysts move down all their stuff, and everyone pretends like they weren't lowered, and then the projections get lowered, and there's a beat, right? There's a beat by a penny because, as you know, there's a lot of accounting tricks that can go on, especially when these guys are getting all this free capital from the Fed. Most of these large caps are not growing their revenues at all. In fact, their revenues are declining. The only reason they're moving earnings higher is they're buying back stock. So
yeah, use that cheap money from the Fed and buy it back.
Exactly. Or they're using the cheap money for LBOs, for acquisitions. They're buying up medium and small companies then that they never would have been able to buy before. But anyway, though, you just have these penny beats, right? And the traders, move the stocks way higher, right? This is a game that's played every single quarter where the earnings are revised down and then there's a penny or two beat. And the stocks go higher, and Wall Street just says, oh, there's a beat. So you hear it on CNBC or the traders talking about on Fast Money, oh, they beat earnings. But what they don't say is that the revenues and earnings were revised downwards like 3, 4, 5, 6 times by 30, 40, 50, 60% every single quarter, and it's even more than that over the year. So it's just go back and look at some of the real estimates and check that, and the stocks are going higher anyway. David Einhorn is still buying stocks because he has these investors and there's a lot of pressure for him to continue to make money, but he's writing like oy vey, and he's venting about, this is not what's supposed to be happening. This is a ridiculous game. It's been going on for years, and he's wondering how much longer it can go on.
And not only that, is that they're also not including a lot of items on the balance sheet and fudging the number to make it look better than what it really is, especially for the banks, because they're doing a lot of make-up accounting where they just make up a lot of stuff in their financial statements, and nobody knows or understand what it means. So people should look out for that as well, because we're starting to see a lot of companies take out liabilities that are not on the balance sheets anymore.
Yeah, well, actually, a couple of banks complained about the Volcker rule because they were questioning. These are a couple of banks in Utah. They were questioning whether they're solvent if the Volcker rule went into effect, because if they had to value their assets at market value, they wouldn't be solvent, and you have to let them value it at maturity, quote unquote value. So they're playing all sorts of accounting gimmicks. A lot of the banks they're zombie banks, and that's one thing I found interesting.
Yeah, I mean, guys, in terms of the actual, if there's value in the stock market, we could talk about this later. But, I just don't see a lot of value in a lot of the large cap stocks, especially the dividend ones. The market's just chasing anything with a large enough market cap size and a yield. It's chasing it way higher. These things are bought rapidly on dips. You're seeing a humongous amount of IPO activity from private equity dumping dividend-paying profitable businesses onto the public. You're seeing the oil industry do a whole bunch of spin-off assets with master limited partnerships for pipeline things, and these things are way oversubscribed, and the valuations for the MLP things are, for a brand new issue are very, very high. And, it's just pretty amazing how desperate the market is for yield because the Fed and other central banks, but mostly the Fed, are manipulating interest rates. It's forcing people farther out the risk curve to chase, especially because I think, the bond market, I don't know how much longer the bond market can stay at reasonable, at a low yield environment and be in a quote-unquote bull market. I think the bond market's starting to crumble.
And that's one of the markets that's still in a bubble. And one of the markets that's not actually overvalued and very undervalued is the commodity sector. Commodities in general in 2013, except maybe for oil, a pretty bad year, especially for gold and silver. Gold and silver took a big beating in 2013. Gold went from 1,700 to as low as 1180, 1200, and then silver went from $32 all the way down to around $18.70. And I think that took a lot of people by surprise. And a lot of people were crying manipulation. Other people were saying, well, this is long overdue, technically, because gold had been going up on double-digit return for over a decade. So it's not sustainable in the short term. It needed a painful correction before it continued to climb higher. And that's what happened this year. A very painful correction that was needed. It was healthy for the industry. And the same for silver, too. Ever since 2009, silver went from around $8 to all the way up to almost $50. And now it went all the way back down to $18.70. So this was long overdue, and it was needed because there was a lot of fat in the industry. It needed to be trimmed down.
Yeah, and I think that's a great point, Mo. And, I wasn't planning on talking about commodities this early, but, yeah, that was a big story, was gold being down. And the other surprise, let's talk about gold later because we'll talk about all the other commodities later. Let's talk about Bitcoin now. Bitcoin was the top-performing the top-performing sector in 2013 out of anything by literally an order of magnitude. Yep. It outperformed everything by leaps. So, part of the manipulation or whatever that happened in gold or whatever correction, there was clearly money. I don't know if you guys agree with this, but there was clearly, to me at least, money that left gold and silver. People gave up on it, and it started chasing Bitcoin.
Well, that was published in the Street Authority, so I saw that too. Go ahead, Mo.
I'm sorry. I was going to say that Bitcoin started the year out at $13, $14 and went all the way up as high as $1,200. So almost 100-fold increase there. And, one thing that Bitcoin has is that gold and silver doesn't have, it's free market forces. And so when Bitcoin went all the way up, I think it was in reaction of people that dumping their fiat currency and looking for something better in terms of another fiat currency, and they all went to Bitcoin. And a lot of people got fed up with gold and silver because of the manipulation and painful correction, like you said, Jason. And so those people went to Bitcoin as well. So one thing that Bitcoin has is free market, and gold and silver doesn't have that right now.
Yeah. Well, I was going to say Bitcoin has a free market for now, but I expect, this isn't a 2014 prediction because it might happen later, but I think the government will get involved.
Yeah, I agree.
Because they're going to do whatever it takes to protect their monopoly.
Quo, right? Yeah.
And people already hate gold and silver, at least the West does, not the East. The East clearly doesn't. But the West clearly hates gold and silver, so they might be saying, well, we already got the perception on gold and silver down. Let's go after Bitcoin now. So who's buying the Bitcoin? I don't know. I wish there was a way of looking at it. It could be a setup.
I think libertarians really like it a lot. Owning Bitcoin in your portfolio as a hedge to your physical gold and silver or mining stocks is definitely a good idea, owning some Bitcoin, and maybe a few of the other competitors. I think most of the copycats, and there's already over 40 other digital currencies or virtual currencies, and there's many dozens more on the way, so there's going to be, over 100 probably in the next 2 or 3 years. I think the majority of them are going to fail. But, it's just amazing, though, seeing technology like this. Bitcoin has, billions. I listened to an interview with Eric Voorhees, who's a Bitcoin entrepreneur at, I think, Coinapult. And we had Gabe Sukenik on, who's one of his employees. And, he was just saying, there's billions of man-hours of computer programming and updates and constant code fixing and all that stuff going on into Bitcoin supply chain companies like the virtual wallets and the Bitcoin exchanges and improving the Bitcoin code and all these other things. So I think that's pretty amazing. Mo and I and John, we went to the 2 years ago, almost exactly 2 years ago, actually. We saw Peter Thiel, who was one of the early investors, angel investors in Facebook. He was a co-founder of PayPal. He's a very well-known angel investor and venture capitalist in Silicon Valley. We saw him give a talk about how there is no innovation, technology has slowed down, and I could not disagree with him more. I think he's completely dead wrong. Looking at amazing technology and innovation, hard work like Bitcoin, the software innovations in social media and apps, cybersecurity, 3D printing, robotics that are coming down, biotechnology, big data and data mining, all these technology stuff, guys. Like this sector, I've heard Rob Kirby, and I've gotten an argument with him about how, the technology sector wouldn't be good if interest rates were higher. I disagree. Okay, even if interest rates were 10 or 11%, we could go back and debate this, that during the Great Depression, 1929, when everything was at its worst, right, that no one wanted to make an investment in anything, there was new technology ventures like Walt Disney and the radio improvements and all these other things being funded anyway, because there were more profits than the higher interest rates. So I think the technology sector is well capitalized. I don't think there's a lot of need for debt. There's a lot of technology companies without debt that can grow very rapidly. And I think it's just amazing that the U.S., in spite of all, the rules, regulations, taxes, Obamacare, all these other things that the government is just throwing at things to hurt the private sector, to hurt the entrepreneur and the small business, that these technology entrepreneurs are still figuring out a way to get things done and move forward.
Well, look at the internet and the website search engines. You can find anything you want on the internet. It used to be Yahoo. Google overtook them. And, I definitely agree that with higher interest rates, technology sector would do well. My only thing is, like, in the stock market, if higher interest rates came and there was a huge market sell-off, I think technology share prices would sell off with it. But they wouldn't crash. They would survive. It wouldn't be like the banking sector, which they would survive and they could thrive and possibly break the pre-sell.
Well, if there is a dip on some of the quality technology companies, I think that would be a fantastic bargain. If there is a major correction in those, because whether there's a 3D printing innovation or a new cancer drug that cures a whole bunch of cancer or something else, then that's going to be a good investment over the long term. So I think small and mid-cap companies who can actually, innovate still and grow their revenue, their earnings, their profit margins, those companies I think are still going to do well during whatever, inflation, deflation, stagflation, hyperinflation, whatever.
And the technology sector is one of the few sectors with a little bit more freedom and a little bit less regulation. I'll say a little bit more free market than compared to other sectors like the banking industry, the commodity sector, and et cetera, et cetera. So I think that's why we're still seeing a lot of innovation in the technology sector as well. Because they have...
Oh, go ahead. No, sorry.
No, go ahead.
I was going to say, looking just at Google, their cash flows, investing and financing cash flows are dropping, but operating cash flows are going up, which that's a sign of a healthy company. They don't need to take on debt. They don't need to finance cash flow through debt, and they're operating, so their operations are going well. So, that I think just looking at that basic part of cash flows, that they can do well in high interest rates.
Oh,
Yep. And,
go ahead, Mo.
sorry,
Go ahead.
I'm sorry. And also one of the trends that we're seeing in 2013 is the rise of the demand for robotics and big data as well. So we're starting to see a lot of companies, and 3D printing. So we're starting to see a lot of companies in that area start to form and become popular now as well. So I think that trend is going to continue in 2014.
Exactly, I completely agree. And there's clear bull markets in 3D printing, in robotics, in cybersecurity, because you have the stuff with Target. You see cybersecurity stuff, whether it's Chinese government or North Korea trying to attack Pentagon computers or American business computers, or regular, hackers wherever trying to steal credit card information from Target or something. You see it every day in the news. So this is something that the private sector, as e-commerce grows, right, and takes a larger share of the consumer pie, cybersecurity investment is going to have to grow along with it to protect the data, right?
Yep.
So at least that's I think a good trend, and it's a good diversification tool in addition to the resource investors, precious metal guys out there who may have put too much of their own money into just gold and silver. Now before we talk about commodities, guys, which I think is like something that we specialize in. We obviously know a lot more than just commodities. But let's talk about the macro situation first and how we see things in different countries, and then we'll talk about commodities, and then at the end we can each give some predictions we have for 2014. Is that good for the rest of the podcast here?
Yep.
Oh,
okay.
I want to talk about one other sector I like, which I think is a good diversification, is the sin stocks. I think especially alcohol, tobacco, as people as things get tougher. People are going to drink more. They're going to smoke more. And I love Asian gambling. Macau. Sorry. I only read. I don't get to listen to them. But Macau, their revenues are at a high now. And so I really like the gambling. And Asian tourism they just love gaming. So I think those are another great.
It's just part of their culture. Yeah, it's just part of their culture. That, when they have some extra discretionary income, they want to go fly to Vegas or Macau. Well, Macau is more convenient now. Or, a nice casino in Singapore if you're mainland Chinese, or somewhere like that. I definitely agree. In terms of asset allocation strategies, obviously owning physical precious metals is important. Owning good exposure to, like, oil and energy commodities is important. Having exposure to technology companies is important. Having some yield maybe from some undervalued dividend stocks. There's not as many of them. You have to really look hard for those right now, especially the large cap American ones. Most of those are overvalued because and they're probably going to go higher, unfortunately, but I think there's just so much liquidity floating around globally, and then there's all that money is coming into the U.S. markets compared to other stock markets because a lot of developing stock markets have not done well, so money has left those markets and come to the U.S. And it's gone into U.S. real estate, U.S. large cap stocks, more liquid things like that. But in terms of the global macro picture, guys, do you still see that we're in every country? Do you agree with my thesis that every single country is in one degree or another of worsening stagflation, and that we've started and are accelerating the crack-up boom?
Yes, I agree. I think Japan might be on the verge of a little bit higher inflation down the road than other developed countries. But any country that's involved in a currency war is going to be stuck in stagflation stage for a while. That includes the U.S., England, Europe, Japan, China, India, and other countries as well.
Yeah, and they're misallocating, due to central planning, like they're misallocating more capital, many trillions of dollars a year is being misallocated on a scale never before seen in world history because they have every single central bank, like Jim Rogers and Doug Casey said on our Roundtable podcast, this never happened before where every single country in the world has been on fiat money. In the past, there's always been, one safe haven or two safe haven countries that have had gold standard. In the 70s, I think Swiss still had gold, right? So there was money that retreated to Switzerland. And there's always been a safe haven. Even in the 1929, people retreated to the U.S. when other markets, other economies were collapsing, and people retreated to the U.S. markets. So you just have a crazy amount of capital sloshing around. It's going all over the place. It's being massively misallocated. And, the Keynesians, I don't know if you guys agree with this, but one of the things the Keynesians just bring up, they only look at the credit, okay? So they all look at credit, and they're like, oh, credit is contracting. There cannot be any inflation. Or prices are declining. There cannot be any inflation. I mean, they've changed what the CPI dozens of times since 1980, right, to hide the inflation even more. Every single government does it, not just the U.S., and, it's just really insane because once the inflation is in the value chain, once, a foreign country, developing country, has imported the inflation the U.S. or Japan has exported, and it's in their supply chain globally, talk to any business person. The Keynesians don't. They don't understand this. Most of them have never worked a real-world job in a business or ran a business successfully or even worked in a business. Most of these guys are professors, okay? Talk to a person at a restaurant or another firm and ask them once they cut down the portion size at a restaurant or something if they increase the portion size again. No, they don't. Okay? They go right back. They're developing a cushion to protect themselves. The goal is to protect your margins to stay in business. No margin, no profit margin, no mission. So the Keynesians are acting like, inflation has dissipated, it's all gone, it evaporated, and I see plenty of evidence. You listen to the conference calls, you see the income statements from a lot of companies on publicly traded. Listen to the conference calls and hear what they have to say. There is plenty of inflation in the global supply chain.
Yeah, there is, especially in India, where they're battling. I hear double-digit inflation. I hear 20-30% inflation. And then Japan had inflation problem, and also China. So a lot of the Asian countries are battling a lot of inflation, and this is why they're buying a lot of gold and silver right now.
Well, Venezuela, they have, now these are the government numbers, so we know they're not the real numbers. Their numbers are 56%. And the funny thing is the citizenry is saying that those numbers are understating the inflation. So who knows what their real numbers are.
And there's toilet paper shortages. The government just confiscated a toilet paper
electricity
factory.
Shortages.
Yeah, and yes, and they're not investing in their oil company anymore, so their oil production is going to fall off a cliff, so they need higher oil prices. And I think the guy who's in charge down there replaced Chavez. He started ordering the army into electronics stores to enforce price controls. It is just ridiculous Marxism down there.
Brick and mortar stores, they seized them. Literally, government has seized them. So the old saying is, what did socialists use before candles? And it's electricity. So
socialism works well until all the money and assets are all gone. Like what Margaret Thatcher said. It doesn't work well at all. That's just a joke. That's only
I forgot one
for
thing.
the government.
Well, Venezuela, you saw the early signs of this because all their talented oil workers and managers and top tier level, they all left and went to Colombia.
Yeah, I mean, to add to another point, Mo, you talked about emerging markets. You have the BRIC nations. China has massively increased the amount of loanable money in their banking system right now. I believe loans since 2008 have gone up 130%. So that's a lot of velocity of money, lending and spending going on in their economy. That's massive. So they've had enormous inflation. India is bureaucratic and a disaster, but, they've been messing with their currency for years, and then they try to blame it all on gold. You have enormous inflation in Turkey, South Africa, Brazil. There's protests in the streets for raising bus fares and all this stuff in Brazil. And Brazil's, having the World Cup and the Olympics in the not-too-distant future. And, those are crony construction projects there that just went there. So there's clearly inflation. And, the people say, oh, well, there's no inflation in Europe. Well, ask a European then if he's having an increased standard of living in Europe. Ask, are Europeans paying less for their cars? Do they have larger food portions? Europe has clearly been ravaged by stagflation, okay? Europe has clearly been ravaged by stagflation. They have very high gas prices. They have most Europeans own at most one car. There's declining portion sizes of food at restaurants and in grocery stores. You'll know this if you're an American, you live in the U.S., and you eat, normal portion sizes and refills on bread and soda and things like that here. You go over there on vacation, it's a completely different story. You're charged for everything. People have to learn to do more with less. That's inflation, folks. So whether or not the credit is expanding rapidly in Europe or not, the average European citizen, their standard of living is declining rapidly due to stagflation. So yes, the credit can contract, but stagflation in the real economy can still occur. So unfortunately, guys, I don't know if you agree with this, but the U.S. seems to be becoming more like Europe on a daily basis. We had Obamacare finally come in now. So do you think the U.S. is becoming more like Europe on a daily basis?
Yeah, we're starting to see that. Not to mention that France just enacted their 75% tax rate on millionaires. So I think France, within a few years, is going to collapse because the millionaires, whether people like it or not, are business owners, and they're the one that provide capital into the economy. And once they leave to another neighboring Europe countries with better regulation and lower taxes, France is going to be in big trouble. And one of the trends that I'm seeing in 2013 is the protests against lower wage. It's happening here in the United States, where a lot of fast food workers are demanding higher wages, and people at Walmart as well. It's happening in Brazil. It's happening in Europe. It's happening in India, Singapore. A lot of these so-called slave labor camp that they have in the Asian countries, and China as well. So that's a trend that people need to keep their eye on in 2014, and I think that's something that's not going to go away anytime soon. And I think the government eventually is going to want to raise wages for the people, and that will have a lot of unintended consequences on the economy.
Well, you already have a couple states, Mo, right? I think there's at least 10 that are very close to enacting higher minimum wage laws here in the U.S., right? So
I think
California already did.
Yeah.
Yeah, so, and D.C. is getting ready to increase their minimum wage to I think $11.50, somewhere around there, for any big retail companies that reside within the District of Columbia. So that's a trend that it happened in result of the stagflation and the money printing. If you think about it, this protest never happened before 2008, 2009, and now we're seeing it everywhere.
Yeah,
so,
and
it's a result of government misallocating the capital and
they don't
messing up
understand
the economy.
Economics. They don't understand sound economics either, because they think, if we magically tell everyone to raise the wages, it'll fix the problems, because the Keynesians are manipulating the prices higher. Because the Keynesians don't understand that the prices need to fall. When people don't have savings, when people don't have wages, when their wages are not growing, or they don't have wages at all, prices have to fall. It's really common sense. It's really effing simple. Okay, guys? So,
one thing. I just want to point out the minimum wage thing is I'm on coinflation.com. And right now, it's 1964 Kennedy half dollar. Value of that today is $7.28, and a Washington quarter is $3.64. So if you were paid $1.25, let's just say $2.50 and a quarter, right now that's $17 per hour. It's not it's not a wage problem; it's an inflation problem. Anytime you see a protest of minimum wage, that means there's an inflation problem.
Yeah, and to add to the stagflation argument really quick, I think U.S. consumer spending over the holidays, because consumers clearly, due to Obamacare and rising food prices, rising insurance, a lot of other rising prices in their daily life, other than electronics and a few other things, and some discretionary items, there's rising prices for consumer staples. There just wasn't that much consumer spending. The only way, and I don't know if you guys noticed this, the only way a lot of stores could get people to shop and spend was to deeply discount things.
Yeah, I've seen it a lot. When I went out during the holidays, a lot of stuff was off 50, 60%. I haven't seen that before. So, and they even started the holiday discount a week earlier, like a week before Thanksgiving. The
I'm still getting
the retail stores are still were discount rolling out discount savings. So even with that, that didn't help. So it tells you how bad the economy is doing in the U.S.
Well, I saw some advertisements where it's 93% off, and I'm still getting holiday stores, holiday sale emails right now, as long as. So obviously, no one's spending because they don't have anything to spend. They won't be knocking off 90% sales if people.
Exactly, John. And the reason is those companies had a bad quarter during the Christmas holiday. It wasn't as good probably as they were hoping. And for some companies in the retail sector, especially some consumer discretionary stuff, that's the Christmas quarter is more than 50% of their income for the whole year. So they're in a lot of trouble. I've said on other podcasts, I thought a lot of the casual dining restaurants would be in trouble. You're seeing Red Lobster either be sold. They're starting to close down a ton of Red Lobsters in the next 2 or 3 years, and you're seeing Olive Gardens close. Darden was a company I was telling people to short a little while over a year ago. Things are playing out the way I thought they would in terms of that. You're seeing the consumer the middle class consumer just get squeezed, and that's what stagflation does. It's the worst of both worlds. You have trouble finding a full-time job. If you find a full-time job, your wages are not going to rise probably, and your cost of living is increasing due to taxes, inflation, rules, regulations, all these other fees. We're hearing property taxes from some people in New York are going up like crazy. California, it's going up like crazy. You had an Obamacare with your health care insurance premiums. The consumer is just not going to have discretionary spending. So, guys, I think we summed up what we think is going on here in the U.S. Let's transition now to our major expertise, although we do cover a lot of other things. But let's talk about commodities now in the commodities market. They were very disappointing for 2013 for many commodities, except for copper, steel, iron ore, and what was it, John? Palladium. Those were
palladium. Yeah, palladium just held up, I would say.
Natural gas did bottom last year, and it started going a little higher, but there's just a humongous amount of shale gas. So let's talk about the different commodities here, and we'll go over them and see maybe what we think is going to happen to them in 2014.
Okay, earlier I did a little review on gold and silver and what happened there. Right now, the bottom is in place. We said that many times recently in the past months. I think what's going to happen going forward is I think silver and gold going to consolidate for the most part in 2014. I don't think we'll see all-time high in gold and silver at all. I'm not going to put price targets on the two metals, but I'll say this. A lot of the gold and silver mining companies are cutting off their supply and putting their mines in care and maintenance stage, and that's taking a lot of supply off market, and people are still buying gold and silver like crazy, especially in the East. In China, there's a lot of reports and articles and data out there that they exceeded importing over 2,000 tons of gold. And the annual mining supply for miners for gold is 2,000 tons. So the demand was incredible in 2013 for gold and silver as well. And the demand also was high in India, where inflation is...
even despite smuggling, right?
Yep. Despite smuggling, the demand there is going up. And they're also buying more silver now, too, since it's cheaper than gold.
Yeah, I mean, we talk about gold and silver a lot, so, I mean, we don't have to talk about it as much. But, yeah, I think the bottom is basically in. We're at the stage here because the mines have the miners, in terms of supply and demand, because that is reality. The paper price guys, I don't know if you agree with this, it's not reality, okay? Because it's not what I see when I look at the miners' balance sheet and when I see from real demand for real metal. There's going to be a supply shortage in 3 to 5 years, maybe sooner, if demand stays at these levels or increases. There's no way supply can produce metal at these paper prices. The miners are they can't stand, the prices are too low. Even though some miners have been able to successfully cut some costs, you're seeing now every couple weeks the higher cost mines start to close. And that's only hurting the supply problems more. You're seeing governments in other countries start to increase taxes a little bit. That's not going to be an incentive to bring on more supply. So I think we've essentially bottomed now. I don't know, maybe we go sideways for a little while, but I think the end of the year, by the end of 2014, I think we're going to end up a little bit higher. So I think then for silver, I think we could see silver prices between $25 to $30 an ounce, because that's a price where most silver miners that have shut down their mines would be somewhat incentivized to maybe bring back their mines online. So you may see that. And for gold, I think we may see gold maybe around 1,500 to 1,600 by the end of 2014, but I don't think we'll see any higher than that. There's just too much technical chart damage, and Wall Street is selling every rally, but the supply and demand fundamentals are going to put in a bottom now at some point in 2014 for sure. And you know, we're gonna get back to reality here and not the paper markets, because you're starting to see physical markets open up, you know, in Singapore. The Shanghai Gold Exchange is carrying a lot more volume. And, you know, you're seeing refining shortages in China and Switzerland. They cannot source metal. Okay, it's an amazing statistic. I've never heard of this before. Jim Rickards and some other people went to visit one of the largest Swiss refiners one of the largest gold refiners in the world in Switzerland, and they said for the first time ever that they couldn't source any gold for a certain amount of time in 2013. So that's not a market where the paper price should be going lower, is it?
No. Well, the other thing is I think we also bottom because just at the price, like it's gone into 1,100, but it's never there very long. I remember the June lows as someone who was a bullion dealer. Now I went back to that job, but I didn't even know it hit 1180. I literally didn't see it, and I watched spot price literally like every minute of every day. I could have been at lunch.
Wasn't it at 1180 for like less than an hour or something like that? And there was a huge
probably
spike up.
Less than that, because I didn't see it, and I watched price all day. And so I could have been at the bathroom. I could have, you know, walked away and gone to the bathroom. I could have been at lunch, but I don't even think it was there for an hour because I never remember it closing. And just recently it was at 1180 and it just shot right back up. And I've read reports now where China is making massive orders at 1100. So if you see spot price at 1100, I think that's a great buying opportunity because it's never there very long. One day it closed, and the next closed at 1190 something, and the next day it was up.
And the GLD was pillaged, like more than 30% of the gold's gone from GLD, and then there's even reports on Bloomberg, that London is out of gold, right? Bloomberg actually let a mining analyst say that they're out of gold in the vault.
Yeah. Well, I think they said nearly empty, almost, it's virtually empty, so they might have like a couple of ounces, but they're basically, we might as well.
Well, it looks to me like the bullion banks are going to have to go to some of the miners like Barrick or Newmont and trick them into hedging. And some of the large guys like Barrick and Newmont are stupid enough to do that, as you've seen in some of the bad deals that they've done over the last few years, guys. They've wasted, many billions of dollars and made their shareholders hate them. So in general, I think you guys agree then that we see slightly higher gold and silver prices, not humongous spikes, because there's some time, the charts have to be repaired, but the fundamentals are starting to take over again finally, right? Would that be a fair summary?
Yeah, I would say so. The fundamentals are taking over. The only way is we have to say, unless there's like a black swan, if they double stimulus, then it could go up faster than it came down. If they say we're going to start printing over $100 billion a month. So we can't predict government policy, but if they slightly increase it and play the games they are, then I would say, yeah.
And let's shift gears here and talk about other commodities. Oil. Oil was, again, in a trading range throughout 2013 again. The highest it ever went was around 110, and the lowest was around $85, depending on what chart you're looking at. So again, going back to the petro business cycle, when the economy did well, relatively speaking, the oil prices went up, and then when the economy started to contract, we start to see the oil price go back down again, and I expect that to continue in 2014 unless we see a war break out in the Middle East or some other external factor that pops up in 2014. Wouldn't you guys agree on that?
Yeah, I expect a trading range too, Mo. Around the cost of production for the average shale oil producer, up to maybe like, I don't know, like 115 or something, or 120 Brent, before, we start to see the economy slow down even further. So we could have a pretty wide trading range. I think the oil sector is one of the best sectors to invest in long term, because no matter what, as long as the economy doesn't completely fully collapse, just to keep the oil production at these current levels, there has to be $600 billion with a B spent per year just to keep the oil production at these levels, and even a little bit replace the reserves that have been pulled out of the ground. That is an enormous amount of money of capital investment. So, the picks and shovels companies, the drillers, the pipeline companies, the oil technology companies, the ones that are doing the deep water subsalt stuff in Brazil or deep water offshore Gulf of Mexico or other places, Western Africa or where else, those guys have so many contracts on the books, billions and billions of dollars worth of deals. They're going to be busy for a very, very long time.
And also, a lot of the shale producers, they need oil prices to be high, and also the deep water oil producers. They need oil prices to be high in order for them to continue drilling for oil. Otherwise, it wouldn't be economical for them to do this.
Well, one other thing I want to point out is just recently they reported that oil demand in the U.S. is at a 5-year high, and I just want to point out that the DOE kept saying we're going to see low oil prices because of increased production, and U.S. is using less and less oil. That's a farce. The U.S. is going to keep using more and more oil, and so demand will increase from the West and the East.
Yes, exactly, John. And when the price of oil goes down, people do more vacations, right? They'll drive more. So I don't know, markets work when the people who are intervening in markets let them work. High prices do cure high prices. Low prices cure low prices.
And exactly. And so for the oil market, there's a lot of value there for investors if they want to invest in oil. Also, the MLPs, which John, you, and also you, Jason, you guys look at a lot in 2013. Do you guys still consider MLP oil trust a good investment in 2014 as well?
Well, oil trusts and MLPs are different. I think the Canadian Oil Trust, there's a lot more undervaluation because I expect the Northern Gateway pipeline to improve, and I think Canadian Oil Sands will do decent this year. I think they'll do well, especially Suncor. I think Suncor is going to go back, not this year, but over a 2 or 3 year time period. I think Suncor is going to go back to its 2007 high. It's a great company, and I think the oil sands sector will revive, and I think it's because China will buy it completely. MLPs, energy infrastructure, they need a lot of spending. There's a lot of MLPs that will benefit from the approval of Northern Gateway Pipeline, so there's still value in the MLP sector, in my opinion, and I think they'll continue to do well. Valuation-wise, they're really high, as Jason said in the podcast, but energy infrastructure is still a bull market. They can still increase revenues, and so I think they are still going to do well, and you get income on the way. That's my opinion.
Yeah, I think I agree with John. If you're a value investor, long-term value investor, the Canadian Energy Trusts are a better value at this point. The MLPs are going to go higher, though. They're in a bull market momentum trade. They've been in a bull market since 2008. They've been one of the best performing sectors since 2008 when oil crashed and then bottomed. But they've been that way because, they're more stable. Almost everyone uses oil to get to work. And they pay out a high yield. So the market has been chasing up, those yield plays. The MLPs are one of those. If there was a market correction and the MLPs, sold off 10, 15, 20%, those would be a good bargain. But if you're a value investor, they're not really a good value right now, unless you have the occasional screw up company where Lynn Energy, things go wrong at Lynn Energy and the stock's under attack. It drops 40% in a year, that's an individual case-by-case situation. That's something Wall Street for Main Street could help our listeners out. Find companies like that in paid consulting where they can find undervalued dividend stocks or distribution stocks, in the case of Lynn Energy. For the long term, they could find companies that will turn things around and go much higher, 2, 3, 4 years from now. Some of the other, natural gas, guys, natural gas, I don't really see a huge catalyst for it. You have the LNG exporting coming in the next couple years, but that's not going to happen in 2014. And then you have all this plentiful supply of shale gas. The rig count's down for natural gas drilling, and natural gas production in the U.S. and shale is still going higher because it's a byproduct with the shale oil. So, natural gas may go a little bit higher each year, but the market has bottomed, I think. I think we said it would bottom last year, guys, right? So, because it was so below the cost of production, and, people just stopped drilling or went bankrupt or sold out their assets for pennies. So I think coal is in the same boat as natural gas. You're starting to see the coal companies, have the same problems the natural gas companies have. Coal's not clean energy, so if you want to invest in clean energy, it's not. But if you're a value investor, I think coal is interesting. You're starting to see India stockpile coal. You're starting to see China buy more coal again. Even Europe has switched to coal because they can't afford, expensive oil or natural gas from Russia because it's a lot more money there. So if you're not as moral, you don't care as much about the environment, if that's not your philosophy in life, I respect other people's views. Coal's a value play here for sure. Although you got to be careful with the balance sheets of companies because some of the companies are just so leveraged. In terms of other commodities, guys.
Can I say one thing about coal too?
Sure.
Also, be very careful of geopolitical risks because it's very popular for governments and environmentalists to attack it. So just evaluate geopolitical risk.
Yeah.
Yeah, a lot of people don't like coal because it's kind of a dirty energy compared to other energies.
Yeah, and the U.S. utilities have stopped using coal. They've switched a lot to natural gas. And, with cheap wind and solar now that the panels are so cheap from China flooding the market with it, they may be buying power from rooftops in California and switching out some of their peak load generation to clean power or natural gas instead of coal. You are seeing a switch, but the rest of the world has not done that. So the rest of the world is buying coal. If you're an investor and you want to make profits, sometimes it's about some people are fully focused, on their morality issues, like I will not buy a gambling stock, I will not buy a cigarette company or an alcohol company or anything like that. So it just depends on the individual person what you want to do concerning that. But I think coal probably has bottomed and there's good value opportunities there if you're not an environmentalist. In terms of the other commodities, though, guys, I think copper, steel, iron ore, they surprised this past year. China started stockpiling them. India started stockpiling them. I don't think they're going to do that well. I know Goldman Sachs...
JP Morgan. I'm sorry. Then JP Morgan also starting to stockpile copper, from what I hear. I remember hearing something about that during 2013.
Yeah, I think they're starting a physical copper ETF or something like that. But, these things have not had the correction I thought they would. Obviously, a lot of it's due to the artificial boom in China, and China's parking a lot of their trade surplus money because they can't put it all in gold. They're putting it into oil, copper, steel. They're building warehouses. They're throwing coal in the harbors. They're just storing commodities. The thing is, they're not really using it. It's just an inventory buildup or whatever. So, and those commodities are not like gold where they're viewed, as money worldwide. It's, a lot of copper for a futures contract, and then you're putting a humongous amount of it in a warehouse. I expect them to have probably a correction this year, but, because I just don't see a lot of real growth in the developing world. The developing world's being hit in a lot of aspects with, worsening stagflation because they're importing all the inflation that the developed world is exporting. So, and I don't really see good supply-demand for that either, although copper, there is some cause for concern for potential supply issues over the long term, but I don't think there's them right now. In terms of the other commodities, guys, what are some of your other ones? We have platinum group metals, uranium, potash, agriculture, and rare earth strategic metals to talk about now.
I guess I'll start off. The two I think are going to do well. It's just a recovery year this year, though. But I thought uranium would do well last year, but I misunderstood the HEU.
Yeah,
But,
you and I had sorry to interrupt you, John. Real quick, you and I had a disagreement about that. I told you I thought 2014. You said 2013. Okay.
whatever. Anyway, I think uranium will do well, and I think potash will recover too. People need to eat, and people will stockpile. So I like those companies. So.
I also think I'm bullish on uranium long term. I mean, the demand for nuclear power is going up worldwide. I look at China; they have 20 nuclear power plant plan in construction within the next 5 years, I believe. And then also look at the Middle East, Saudi Arabia. They're looking into getting to nuclear power. So the demand for uranium is going to go up. So long term, I'm bullish on uranium. So also, if you want to look at alternative energy, geothermal will be a good industry for investors out there to look at. It kind of works similar to buying a mining stock because you have to go mine for the geothermal energy. Most of it in the United States is out west, and also in Central America as well. So I think those are attractive play as well.
Yeah, from a value standpoint. But I said earlier in the year it would take at least 18 months for the revaluation. But these companies have earnings, so they have debt on their balance sheet like a utility, but they have like 20 and 30 year electricity contracts with utilities to supply power. So they have a steady long term contract at a good price.
You guys there?
That are geothermal pure plays, and the valuations they're selling at, they're generating pretty good cash flow now. They're switching from they're switching from no profit to a profit. They just swung to profitability. Finally, they're fixing the problems, and I think they could be good takeover targets for a larger utility company, hopefully at a good premium. And I agree with you guys on uranium and potash. I think finally, I was wrong. I was right on uranium. Last year, I thought uranium would not do as good last year, and 2014 would be the year. I was wrong on potash. I thought potash would be good. Potash, I think, has finally bottomed. There's
I
the
was
food.
going to say the uranium miners definitely bottom. I was going to say because some of them actually, like Uranium One, that actually got bought out at a premium, and you saw the M&A heat up too.
Yeah, that's a good point, and normally that means the bottom in the market. And another bottoming sign is you see supply being cut drastically, exploration budgets being slashed, and we saw that in potash. So I also like, wheat, corn, rice, some of these other sugar, long-term coffee, some of these other commodities, because I think the last couple of years they've corrected quite a bit. And, there's going to be droughts and floods and all these other things, and, they could destroy this type of volatility in the weather environment destroys plants and crops. Even with, genetically modified seeds and all this other stuff, the plants, a lot of them still die. So, you have higher oil price, higher natural gas price, and those go into the fertilizers. If the farmer is using synthetic fertilizers and not, compost, like with organic farming, so their costs are going higher. So, I think energy, I think food, and I think precious metals are going to be probably the top commodity performers. I also like, the platinum group metals. I think China has a really bad air pollution problem. It's enormously bad. And finally, they're requiring, although, being libertarians and free market, we don't want anyone requiring stuff. We would prefer, the private sector did it voluntarily. But, I don't want to be breathing poison. So I guess, that's good that they're realizing that the Chinese government is finally realizing that they have a problem, and they're going to make it mandatory to require catalytic converters, which are used for platinum and palladium, humongous demand increases. And, there's huge supply issues. I think, unfortunately, to play platinum and palladium, I think people should maybe just buy the Sprott physical ETF or buy the metal, because I think the miners, a lot of them are crap. Most of them are located in South Africa, which has huge geopolitical risk, and there's even talks of confiscating mines. Taxes are going up on royalties every year for those things, and then the other supply is either in Zimbabwe, which is hyperinflating still, or in Russia, which is they don't respect private property. So
Right.
I think buying physical platinum and palladium I think is a good hedge to physical gold and silver, and I think there could be really good supply-demand fundamentals for those in the long term, where you might get a nice spike on those. I don't know about this year, but over the long term, as China puts more normalized cars out there with catalytic converters, and China's car demand is increasing every year too. So you're getting 20 million new cars per year with catalytic converters. They're going to make it mandatory probably to put catalytic converters maybe on old cars. That's going to be bullish for platinum and palladium going forward. And then, finally for commodities, it's a really tiny market. You have rare earths and other strategic metals. These sectors have had just an underinvestment in them for a long time. You're starting to see Molycorp and Lynas, who are the two main rare earth producers outside of China, who has basically a monopoly on the whole industry, both mining and the value chain. You're very close in 2014. You're seeing these guys' losses narrow and narrow. You're very close to finally seeing a profit for these guys. Hopefully, the debt will be worked out on their balance sheet, and they'll stop the dilution on their shares. And, I'm not buying any of these stocks right now, but I'm waiting for them to achieve profitability, and then I think they're a good buy. I think the bottom will be put in. Maybe the bottom will be before they fully announce profitability, because someone on Wall Street will have inside information. As we know, unfortunately, guys, it happens all too much. But, once these guys make a profit, I think their debt's going to get worked out by the banks. I don't think the banks are going to let them fail, because they know how important they are to supply, secure supply for the end users outside of China.
Yeah, that people should definitely put rare earths on their watch list for 2014. Keep an eye on Molycorp and a lot of the other, and Lynas and a lot of the other smaller rare earth companies, and see how they're doing financially, and see if they can execute their business model. So before we go forward to 2014 and touch on our other prediction, anything else you guys want to touch about commodities before we go forward?
I think if I had to wrap it up, I see 2013 transitioning to. I think we've put in the. I think the cyclical bear market for a lot of commodities has finally ended. So
Yeah.
I don't know if we're going to have big moves in commodity prices in 2014, but I think we're going to start climbing that wall of worry again, going up that slow staircase, and then maybe accelerating things. Because there is, inflation problems in other areas, in other developing world, it's agreed upon that there's inflation problems, even though the government inflation rates in these other countries are saying it's not as high as it really is in reality. So, I think besides rare earths in the strategic metals, there's manganese and titanium. These sectors are underinvested in. There's graphite. There's innovations coming in a lot of small commodity sectors. You just have to do work and see. You have to do good supply and demand research and find companies that have good balance sheets where their valuations are low, and I think you can do very, very well. I just be careful with the industrial metals, though, because, they've been going higher for a while, and I don't think it's on real supply-demand momentum there.
Well, zinc also has a lot of mine contraction, or supply contraction, so it should do well. It might take a year to fully be recognized by the market, but zinc's one of the few base metals I think will do well over the next 2 to 3 years.
I agree, especially when you have one of the biggest zinc mine, Century Mine, going offline, I think within this year. So I think 2015 will be a good year for that base metal.
Yeah, and surprisingly, guys, the price of the solar panels, the Chinese flooded the market with solar panels. The demand for those is increasing now. You see Elon Musk's Solar City company, right? And because the panels are so cheap and there's cheap interest rates, right? He's leasing out these panels and installing them in people's houses, and people are getting, a really discounted electricity bill. So wind and solar are starting to find a place in the niche because the costs of production have come down because the Chinese, have just been flooding the market with them. It's very interesting that's going on. That should help rare earth demand and silver demand too, because there's a big demand for silver in the solar panels and rare earths in the wind.
Yep, I agree. I definitely agree there. So going forward to 2014, I know we already shared some of our predictions for 2014. So before we wrap up, we want to just put out any of our other predictions we haven't talked about yet. And one of them that we haven't talked about in the technology sector that I see will be on the rise is wearable technology. One example with the Google Glass, which possibly will be rolled out in 2014. I think that will be a game changer in the technology industry, where we'll start seeing people wear the Google Glass to take pictures, use it as a GPS navigator, and etc. So I think that's something that people can keep an eye on with Google. And also we already touched on the robotics, and those are bleh. Those demand is rising, and especially in the military, they're looking into using robotics as well for combat and war. And so that's pretty much all I had for the 2014 prediction. I already shared most of mine. So, John, do you have any other prediction you want to share with us?
I think alcohol, tobacco, and everything will do well. The example of not being overvalued and still finding value in large caps is Anheuser-Busch. That has like a 12 PE ratio, almost 3% dividend yield, institutionally owned 6%, profit margin 23, operating margins 33. There's still good value in the alcohol sector. And so I like alcohol, tobacco, and other stuff to do well. Maybe not great, but they're definitely good income and people always use them. And tobacco, it's so regulated, it's hard for entrepreneurs to come in and unseat like a Philip Morris. So I think the resource sector will recover. I like the sin stock, and technology can always do well. So,
all right, and Jason, do you have any other predictions you want to share?
Yeah, I actually have a fairly like a 10 prediction list, and if our listeners want to copy this, they can email us at wallstreetformainstreet@gmail. That's WALLSTFORMAINST@gmail. I have pretty long, paragraph-long predictions for certain things, but I'll just try to summarize things real quick, Mo, due to time. I think, first of all, let's go top down. The central planners, I really see 2014 in a lot of aspects as kind of a continuation of 2013, that I don't think we're going to see, Japan. I don't think we'll see the United States hyperinflate. It's too early. I think we'll probably see the U.S. convince most of the people that things are fine, at least through this year, for the most part. I think what we'll see, though, is that the stock market will probably have a small correction, and then QE may increase, and then it'll start going back up again, because they just believe, the Fed and other Keynesian central planners in the central banks believe so much in the wealth effect, and there are so many other reasons. We've touched on these ad nauseum, that they want higher asset prices. So any kind of small correction, they're going to come in and print, folks, and they're most likely going to increase the QE program on the face, even though it's already larger, and try to move the stock market higher. I think, unfortunately, the bond market, well, if you're free market forces, but if you're holding in bonds, I think, unfortunately, you should be getting out now if you're not already out. I think the bond market has showed cracks. You start to see interest rates rise. I think the bond market will show more cracks in 2014. It may even start to enter a serious bear market, and the Fed may have to drastically increase QE to prevent interest rates from going, to 4 or 5 to knock them back down. So that's something we could see. Gold or silver, I talked about my predictions. Something important that the listeners need to watch to see if the system is on the verge of collapse is the Japanese yen. Watching the 10-year interest rate, the gold price, the general stock market indices are all important. Something else to watch is the yen. The Japanese yen was hovering around 100 for a while. It has now moved very quickly to 104. It briefly touched 105. Early in 2013, it was around 80, and we said it would fall a lot. It dropped to, at one point, Mo, it went from 80 to 100 in a year, like an enormous move.
Yeah, 25% devaluation against the U.S. dollar.
Now, I think clearly, Mo, the trend now for the yen is down more against the dollar, and it's going to start accelerating. So I would expect then, my best educated guess, by the end of 2014, the yen to 115 to 120, which would be a huge move. But the Japan has even more financial problems than the U.S. and any other country. They've been doing QE and other gimmicks for even longer, and they have a lot of fundamental problems with their economy where they cannot run trade deficits. And Fukushima has really accelerated the doomsday clock because, they have expensive energy imports. So they have some real tough choices to make in Japan. Will they fry now or will they fry later? Oil in a trading range, we talked about that, I agreed. I think Google is going to be the premier large cap technology stock. I think the trend trading hedge funds in 2014 are going to move it. It's around, a little under 1,100 now? Or around 1,100?
Yes.
Hmm?
Yes.
Yeah, so
around 1,100. So
I'm thinking at least 1,300 by the end of 2014. There's obviously fundamental reasons for it. You have Chromecast. They're going to start making money in robotics, and then you have Google Glass launching on top of some other stuff in the pipeline. But the people, the Wall Street traders, the hedge fund guys, the trend traders who manage billions of dollars, they don't give a shit about fundamentals. So if the chart's looking good, if we move to 1,200 or 1,250, they're going to push that thing to 1,350, 1,400 very quick, because only the chart. They don't care about any fundamentals really, as long as there's an earnings beat or anything like that, or the chart looks good. I think we could see interest rates spike briefly to 4 or maybe even 5% in 2014. However, it will not stay there. That would be a situation. I don't know if you guys agree with this, but that would be a situation where we'd see the QE expand again to try to buy the bonds to knock them back down. Because if interest rates do go that high, that temporary spike could cause a large bank, most likely a European bank like Deutsche Bank, to need a bailout, or the bank is, nationalized or chopped up into pieces and sold off, like what happened to Bear Stearns or Lehman type of scenarios.
Well, just the one thing is, when it went to 3.5, Obama met with all the banks. So,
well, he met with the American banks, but we already know the Fed is bailing out European banks and European governments, and they're still in a lot of trouble. So I think let me put it this way. I think at this point, the European banks are more vulnerable because they didn't officially recap their banks, and the Fed, for most of the QE programs, besides the money going into the stock market and real estate market and stuff and bond market, that money, a lot of it, especially starting with QE2, Dave Cullum has a really good piece on this for his 2013 year in review, Future 2014. A lot of that money is also going to Europe. So Europe is hemorrhaging right now. The only reason Europe hasn't fully collapsed is because the Fed is bailing it out. Unfortunately, I think higher food prices, part of prediction. There's just so many developing countries in Africa, Middle East, South America, Asia. They have the highest percentage of annual income spent towards food and gasoline. So they are the most sensitive. Unfortunately, I think there's going to be an Arab Spring. I don't think it'll be in a large country, but I think it'll be in a smaller developing country in one of those continents. And I think the IMF and other central planners are planning on another Cyprus-style bail-in to test. Because you just see, these white papers coming out from Larry Summers and more of these other buffoons that are academics and Keynesians that, we can't do any more. Public sentiment is against any bailouts. So we're going to get the depositors because they're only creditors, right? We can't hurt the bondholders because the banks can't write the assets down, right? Because then they'll go bankrupt. So unfortunately, I expect another test, real-life science experiment, which is another science experiment, with the QE programs. I think they're going to try another bail-in, maybe in a small Eastern European country, or, another supposed safe haven like, I don't know, Panama or something. That I don't have any advanced knowledge of that, but, just one of those banking countries that's known for their banking, that's not a real big part of the global economy. They might try something there and test things out. So that's another prediction I have. So people then are going to have to be careful then about where they park their money in banks. Unfortunately, this is the world we're living in now, where people, the main people in power, the economic and political elites, they can change the rules anytime they want. And, we may have a developing periphery country collapse due to a mixture of those food prices and revolution and bail-ins and things like that. We could just have people say enough and, march on the government and overthrow it or something like that. So in general, I think those are most of my predictions. We talked about the commodity cyclical bear market ending. I think food, energy, precious metals, including platinum and palladium, will probably be the stars. I don't think they're going to go up a lot, although some of the miners may go up more than the actual commodity price, because finally they might start making some money. And there's going to be some good mergers and acquisitions in those sectors.
Yeah, that's true. Some companies might go up a lot more because they're going to go from losing money and having to take on debt or whatever to actually making money. So
Exactly. So just because the commodity price didn't go up a lot doesn't mean you shouldn't buy the commodity. It could mean a humongous difference between a huge loss and then a small profit. That could move the stock a lot higher. And then, Mo, you touched on this. I think inflation or deflation, I think the technology sector in Silicon Valley in the U.S. is very well capitalized. I don't think they use a lot of debt at all for the most part. So I think 3D printing, robotics, big data, some of these other mobile miniaturization, biotech, I think these guys are going to do pretty well. Now, maybe, if there's a general stock market sell-off, they'll drop, right? Because in 2008, when the market crashed, everything dropped. But these would be good buys because I think there is legitimately real growth, and they are solving problems that other sectors have created in the world.
That's correct. With increasing input costs, people are looking for automation. They're looking for replace human workers with robot machine to cut down costs. And we think it's a good inflation hedge to invest in technology because a lot of people,
exactly.
A lot of companies are looking into the sector to help cut down their input costs.
And exactly, and even Chinese factories, I believe Foxconn, which is the largest factory in the world, even they're installing robots in the next couple of years, a lot of robots to manufacture. Yep. And, there's a lot of reasons for that because food prices are going up. They feed their workers there. And, here in the U.S., they don't want to pay, the employers don't want to pay workers a higher salary. They don't want to pay rising Obamacare premiums, and they don't want to pay, a retirement package, no defined benefit or no matching 401k. They don't want to pay those things. And a robot will work 24/7, 365. You don't have to pay them overtime. You don't have to pay them anything else. So, that's the world we live in, folks, where the technology gains have increased so much that I think investing in robotics and things like that as a hedge are a pretty good idea to diversify your portfolio. Maybe you had too much in gold and silver, as I did. I started this year. Not 2014. I started 2013, especially buying a lot more oil stocks with dividends because I wanted more yield in my portfolio, things like that. So, anything else you guys want to talk about?
No, I think we've pretty much covered everything, and 2014 will be an interesting year. A lot of things to look out for, a lot of trends, a lot of signals and signs to look for in the economy and in the market. And if people have any more questions or topics that they want us to discuss, please email us by going to our website, www.wallstreetformainstreet.com or wallstreetformainstreet@gmail.com. You can also email us with that address as well. So that's pretty much all we have for now, and I hope people will tune in and check out our other podcast that we're going to roll out this year. We're going to try to get new guests and talk about other sectors, and on top of the gold and silver and commodity sectors as well. So Jason and John, thank you for your time. And for our listeners out there, good luck in 2014.
And Happy New Year, everyone.